So here we're going to pivot to Asia, and we want to start off with China. Obviously, they're the behemoth in the region, and we want to look at the pressure points that remain. And one of the things that we've been talking about, and I think sometimes maybe I get overzealous to the downside. We've been saying from the beginning, it's not going to be a recession in China. It's just that the market had these lofty goals for Chinese growth, and we're saying it was never 5.5%, let alone 5%. So it's 1%. And the reason why we may come across so bearish is because 4% difference is massive, especially when you're talking about a country as large as China, which is why we've been trying to highlight there's no way to get to this point given the pressure points that are there. But it's not that they're shutting down. Like China isn't sitting there going, well, it's over. Sorry, guys, and then walking away. No, it's like there's still a business here. There's still an economy that's happening. It's still the second largest economy in the world. But it's important to look at what the PBOC is doing. And you're getting rhetoric from the CCP and from politicians, but the PBOC is holding firm on what we've been led to believe was likely in 2019. So foreign direct investment came down 4%. Again, we don't see that changing just given the avoidance under the political issues that remain, the fixed income, the deleveraging, the leverage issues. There's no reason to continue to increase in China at this point in time. Now, the 1-year loan prime rate was expected to be at 3.4%, but it was only cut to 3.45%. The 5-year loan rate was expected to be cut to 4.05%. They didn't cut it at all. Now, that's where we continue to see the different pivot points. The PBOC is holding firm on, we will reduce leverage. We're going to provide some support, but there's spots of that the economy is okay. So we don't have to get overly aggressive because again, it's not like they're in a recession. They're just facing massive pressure on some of their growth drivers. It just means that they're not going to have growth, but also at the same time, how do you achieve continuous growth? Because it's the law of big numbers. To go from $1 to $5 is much easier and has a huge percentage move versus going from $500 to $505. So again, you're seeing some of this inherent shift, which naturally happens. But as we've been talking about, local government income and then sales and the LGFVs remains a huge issue. So China's fiscal revenue grew 1.9% in year-on-year on July, slowing by 3.7 percentage points from June, with tax revenue growth slowing by 9.1 points to 4.5%, while non-tax revenue falling 14.9%. So again, they're not getting tax revenue, or limited tax revenue, which is putting them in a tighter spot than even they were before. Local government income from land sales has declined because there's a mixture of not wanting to sell at low prices, but also the lack of a buyer. You still need a buyer out there, and some, as we've showed with permits, with new lease space, with new buildings, there is none. And there's a limit to how much is there, and that's also slowing it down. So it's a price issue, but you're also seeing an impact in terms of what is actually available. Now, it's interesting when you look at the underlying, so this is coming from the Financial Times. The underlying resistance is political, said a senior state banker. Bridges and roads are built in response to calls for economic growth and poverty alleviation. Why, he continues, should the localities now shoulder all the costs on behalf of the central government? The surge in local government debt was the inevitable consequence of Beijing setting GDP growth rates far in excess of what the productive economy could deliver. And that's the right sizing that we're talking about. It's that you had a ton of froth that was created, or this, let's call it fake growth, that was fed by cheap debt and over leverage. So for every it took $3 to generate $1 of economic growth. Well, you have to right size that back to closer to where the real economy can support it in order to continue that growth, but more importantly, to deleverage. And that's what the PBOC is trying to balance. And to their credit, I think they're doing a fairly good job of managing that rhetoric and trying to drain those yuans out of the market. I talk about it on Twitter. When you look at what's expiring, they're slowly pulling money out of the market. They're not doing it aggressively because they also have to try to support the currency, which is weakening against the dollar. So they're trying to thread a needle, and to give credit where credit's due, they're doing a fairly good job of it. The surge in local government debt was inevitable, and by passing much of the responsibility of achieving these growth rates onto local governments, Beijing left them with no choice but to engage in activity which was increasingly non-productive and would inescapably leave them struggling with debt. Which is why, because the CCP wants to be able to say, we have no debt. And as I get pushback on Twitter where it's like, oh, the CCP is in much better position than the U.S. federal government. It's like, no, they just hid it better. And we aren't hiding it. And not to say that we don't have a debt problem, because we do. It's just, it is much worse in the Chinese level because of the different layers and the pockets in which it was put into place. So Beijing left them with no choice. And among other things, this means that resolving the debt isn't just about uncovering hidden debt and finding ways to restructure it. It is most of all about abandoning unrealistic growth targets and accepting much lower sustainable growth rates, perhaps 2 to 3% or less. Now, this is coming from Michael Podis, which, as you can see, I have talked about multiple times. He is the author of that. If you want to go and follow him, highly recommend it. But it's true. Now, I still think 2 to 3% is still too high. I would say that it's likely closer to 0.5 to 1%, and then slowly getting back to 2%. And I'm pretty sure if I were to engage with him, which if he's listening or watches this, I would love to talk to you, is that that's likely going to be needed over the next year or two before you can start to get that back to where it should be. Estimated local debt as a percentage of local GDP, you get an idea of how massive it is, but it's cumulative, because as this all rolls up, that's where you get a lot of these overhangs, which is why you can't, when you look at it, and this is just looking at some of the bigger regions, because it is massive. State-owned assets held by local governments, also a huge increase, because when you look at the state-owned side, it's like, well, are they going to sell to try to cover the debt? Can they do it? Is there a fire sale that's available out there? Experts are also expected to suggest increasing the maturity of loans to LGFVs to 25 to 30 years and cutting interest rates, giving them some breathing space to find new sources of revenue. Banks would indirectly absorb the cost. The risk of such restructuring has prompted some investment banks to reassess the ratings of state banks with high exposures. Commercial banks' profit would be 6% lower if 10% of the LGFV's loan holdings were restructured, according to a historical stress simulation. So the problem is, now banks are going to have to absorb that loss, which means that their leverage ratios are going to get essentially exponentially worse, which means that you're going to have to leverage yourself more. You're going to have to your leverage ratios are going to go up. You're going to have to demand more assets and collateral, which is then going to limit the amount of new loans that can be put out there. But that's a good thing for the PBOC because they want loan growth to slow. But then the question is, do you then layer in and essentially create more problems for some of the banks that were forced to, for lack of a better term, take some of this excessive LGFV debt? And that would then create some of the bigger problems, which exist when you look at the pressure on where the market, where the younger generation sees China. So there's been a huge push on building up the CCP, explaining how great it is and the future that it holds. But as, which you can say, but when people actually hit the ground running and find widespread unemployment, low wages, the lack of social mobility back to segment one, people get disenfranchised. No matter how much you try to drill that in, people get disenfranchised and angry, and they want change, and that's the last thing that you want in a communist country is they don't want change. They want to hold power. And so this is going to be a pressure point that's going to have to be watched. as the Gen Z level continues to get a bit more frustrated, and why the government is going to want to try to get after that. Now, when you start looking at China's state versus private company tracker, you're seeing that state-owned enterprises are taking over more, which is something that, while you've seen some commentary that Xi wants to support more private sector growth, and you saw the additional non-public, the additional mixed ownership, now that you're seeing that reverse, but that's going to be a problem because as a foreign direct investor, do you want to invest in something that you may not be able to control? 12 small and mid-sized Chinese banks have been given the go-ahead to make changes in their shareholder stakes. The group consists of 5 urban commercial lenders and several rural banks. And for the urban commercial banks, the changes mostly involve their state-owned shareholders or other local state firms taking bigger stakes, while for the rural banks, it mostly entails their main sponsor bank lifting their equity holdings. So they're trying to inject capital, but it's difficult given some of the state enterprises are already major shareholders. And as we talked about, there's not a lot of tax revenue and they're sitting on big losses. So it's going to be difficult to try to force that down and then put additional liquidity into some of these regions. Now, when we start looking at real estate total return index, you get an idea of the pain. And the problem is a huge amount of people, as well as corporations, are tied up in this. And that's why when you look at consumption from a consumer standpoint, well, they have a lot of their life savings that were stuck, and they've taken a huge hit on a mark-to-market level when you look at that drop, because they were getting very involved in the early 2010s, doubled down at the end in 16 into 17 when they were asked to take more. And here you saw that big pivot point, which has continued to drop. China real estate debt nearing lows again. And it's because, again, there's lack of a desire to jump into some of these areas. Financial China FDI, as you can see, starting to kind of crack a bit. Growth momentum weakened further in July when you looked at construction starts, property sales, but then when you look at retail sales, fairly flat. Exports are coming down. So this is what we've been talking about, where we've been talking about how retail sales are missing estimates, but they're still positive. It's not like they're negative. And it's just when you look at the trend and where this is pulling, it's all pulling into a much slower backdrop. This just puts into perspective some of the surprises when you look at the Chinese loan rates. And again, that 5-year loan rate, that is going to slow some things down, because when you look, there's still no relief for Chinese real estate, the Beijing real estate, national real estate level, and property sales by developers. When you look at state-owned, has increased on the property sales by developer, because again, they're trying to inject that capital, and it's easier to do it from a state level than a private level, where property sales by developers, the private has essentially shrunk into nothing. And excuse me, and that was some of that artificial growth that we saw in 2020 into 2021. And it's funny because the China Beige Book on Twitter, the Economist said, how things are breaking in China in 2023. It's like, well, 21 and 22 also weren't good years. It's all a matter of perspective, because they're like, everyone's now waking up to the story. It's like, no, this was always a problem. And there is a cyclicality behind it, but also structural. And the structural issues is where we continue to see those problems. This is looking at some of the fixing. When you look at the CNY versus USD, they continue to try to protect it as the CNY continues to weaken. They're coming in to prop it back up, but to do that, you're essentially selling dollars to buy renminbi, to buy yuan, to try to protect. So everyone looks at this and says, oh, well, China is getting rid of the dollar. It's like, well, they're getting rid of the dollar to protect themselves. It's not like they're getting rid of the dollar because they hate the dollar and they want to move on. There is a structural problem that they're trying to address by selling down USD. Now, weak exports are dragging the Chinese economy down. And if you think about what's been weakening, it underestimated the big impacts from exports, because we don't see this coming back up, especially when we look at other entities within the Asian markets. Overall debt has continued to rise in recent years. And this is just, again, accumulation when you look at all of them, from household to government to corporate to households. And the corporate side, it actually includes LGFVs. And you're seeing how it's continued to rise in 22. And the biggest focus, the focal point, if you remember, in 19, when it was at a record, the goal for the PBOC was to bring it down. Now, there was some slippage with that, obviously with COVID, zero COVID policy, and now they're getting back to this level because they have to deleverage. Property sector deleveraging began in 2021, back to the comment from China Beige Book, and it's likely to continue because that is where the biggest issues reside. Developer loans have continued to rise despite overall lower leverage, and it's just a matter of rates because rates came down a bit trying to incentivize and protect, but even that needs to continue to roll as the project and other loans account for 76% of developer borrowings, and the project loans is where you're getting caught up because some of those loans, or a large part of them, are being supported by MVPs and consumers that are either forward buying by putting large down payments or using some sort of trust structure to provide that money, which is where we're seeing those problems. Residential construction drives just over 12% of GDP, but broader property and related services are 30%. The ongoing property slump may reduce GDP growth from about 1.5%. That's a big number. And that's what we've been trying to say is it's not that this is going to pull them into a recession, because it won't, but it means that 5% or the new reduced numbers that we're seeing of 4.5% are still too high given what's there, as the total trust assets and exposure to property have declined, but they still are massively tied to it, which is something that continues to create a drag. And housing contribution year on year to GDP is that proof, going all the way back, and how it's going to continue to be a problem as you project out over the next few years. Housing related retail categories perform the worst. China's housing slump is hitting consumption. One reason the recovery is disappointed. The impact on the property crisis on investment is well recognized. The effect on consumer spending, less so. But one channel is clear: spending on home appliances, furniture, building materials has dropped with the property downturn, and that's about a 0.6% droppage point. As we've been talking about, it's retail. Some of the experience stuff has done well, but the underlying growth structures of physical goods, physical assets, and services, local services, continue to be in decline, creating more pressure on the underlying economy. China sales managers started to pick back up a bit, services back in expansion, but real interest rates have spiked due to the falling inflation levels, which are also creating some of those headwinds. So while we'll get some recovery, because as we were saying, it's not like we're going into a steep recession, there's going to be a lot of overhangs when you look at real rates and how the market can address them. Growth signposts have faltered. Consumer confidence is down again. Business surveys, investment intentions, business conditions all moving down as the debt service ratio for companies and households continues to be an overhang. And when you look at the level of consumer confidence, the pressure on their underlying holdings, because some of them could have taken upwards to 80% hits on their real estate exposure, which is why that debt service ratio is going to be even bigger of a problem because of the losses that were incurred from the drop in housing. Japan 10-year bond continues to push higher, putting more pressure on the BOJ. And now Japanese savings are excessive, but they've always been excessive, but it's unlikely you're going to see them unleashed because wages have to go up. People are struggling under the guise of inflation. And until the BOJ gets serious and likely raises rates, takes away their target, you're going to see likely not hyperinflation, but inflation accelerating again. As you can see here, Japanese inflation picked up again, 2.7%, ex food and energy up 4.3%. You can see that reacceleration, that pressure continuing, which is why Japan is going to struggle. Taiwan export orders increased a bit. Consumer confidence in South Korea kind of flatlined. So again, you're kind of in this balancing act. But then when you look at South Korea exports, they had a sizable drop. They're supposed to drop, seasonally speaking. This is a low period. But you can see it's much lower than it was in 2018, in 2021, and in 2022. So again, you're seeing that pressure as South Korean exports are down 16.5% from last year because they sell a lot into China as well. So it's not just Germany, it's others that are seeing that slowdown. And South Korea exports, when you look at the year on year, are down 16.5%. As you see this pressure point. And again, that's volume versus value, all of which are moving down and creating that underlying pressure. So that's what we have for you today. That if you have any questions, please let us know. We'd love to hear from you, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.